All right, let's dive into a story of corporate survival. Today we're looking at Incredible Holdings, and let me tell you, their latest financial report reads more like a thriller than a business update. It's a story of collapse, of desperate measures, and a really uncertain future. So let's get right into it.
Just take a second to look at this number. Let that sink in. Negative 95.19%. Now, this isn't just the stock price dipping on a bad day. This is the company's total revenue, pretty much wiped off the map in just 1 year. It's the kind of number that makes you double-check if it's a typo. But it's not.
And that really brings us to the big question for this whole explainer. How on earth does that even happen? How does a business that was bringing in money just stop? Was it some single catastrophic event, or a slow decline that suddenly went over a cliff? We're going to find out by basically performing a financial autopsy, piece by piece.
Okay, so here's our game plan. First, we'll tackle the main symptom, that crazy 95% revenue collapse. Then, we'll dissect that decline to figure out the cause. After that, we'll see if there's any silver lining in how they controlled costs, check the company's vital signs on its balance sheet, and finally, we'll look at the road ahead to figure out the prognosis.
So let's start with that headline number, right? The big symptom of what's going on here. You know, revenue is the lifeblood of any company. It's all the money coming in the door before you even think about paying bills. And for Incredible Holdings, that flow of money has basically dried up. And here you can see just how bad it is. Last year, same quarter, revenue was 104,000 Singapore dollars. This year, just 5,000. That's a drop of $99,000. I mean, to put that in perspective, a publicly listed company bringing in only $5,000 in a whole quarter is, well, it's almost unheard of. This isn't a slowdown, it's a full-on shutdown of their sales.
Okay, so we've got the what. The revenue is gone. Now we need to figure out the why. Where did this come from? A 95% drop isn't just one product having a bad month. This points to something really fundamental, something broken across the entire business. So we've got to look under the hood at their different business segments.
And this is where it starts to get crystal clear. Look at their main business lines. The luxury goods segment, it went from making $28,000 last year to zero this year. It just stopped, not a single dollar. Then you've got their distribution business, which was their biggest earner at $75,000. That fell off a cliff, down to just $5,000. It's like the two main pillars of the company just crumbled at the exact same time.
This table just lays it all out in black and white. This wasn't a problem in one little corner of the company. It was a total systemic failure. Every single way they made money was either completely shut off or down to a trickle. Luxury goods, gone. Distribution, down 93%. Even their tiny loan financing business went from $1,000 to zero. The entire sales engine of the company has seized.
So what's the official story here? Well, in their own report, the company points to two things: less customer demand and, maybe more importantly, a fiercely competitive landscape. This tells you that they were probably outmaneuvered. As the market changed, their competitors got more aggressive, had better products or better pricing, and Incredible Holdings just got left in the dust.
Now, a 95% revenue drop would normally be a death sentence. But this story doesn't quite end there. When you're facing a crisis this big, you have to react, and you have to do it fast. So the next question is, what did they do about it? Let's check out their expenses.
And here, we see the first sign of a real survival strategy. They started cutting their administrative expenses. You know, things like salaries, rent, the basic costs of keeping the lights on. They managed to chop those down from $241,000 to $176,000. That's a 27% cut. And this is so important. While their income was vanishing, they were actively, aggressively trying to slow the bleeding.
And the report tells us exactly how they did it. These weren't just abstract cuts on a spreadsheet. These were tough calls. They let staff go, which cut down their payroll. And they moved into a smaller office to save on rent. These are classic, painful moves a company has to make when its back is against the wall, just to live to fight another day.
Okay, now this is where the story gets really, really interesting. This chart shows their gross profit margin, basically how much profit they make on each sale. And somehow, while their sales were collapsing, their profit margin more than tripled, jumping from 12.5% all the way up to 40%. So how on earth does a company losing almost all its business suddenly become more profitable on what little it has left?
This slide breaks down that little mystery, and it's a pretty cool lesson in how numbers work. See, while their revenue fell by 95%, The direct cost of making those sales fell even faster, by 97%. It went from $91,000 down to just $3,000. So that tiny bit of revenue they did make, that $5,000, only cost them $3,000 to generate. It's a weird statistical silver lining born out of a crisis, but it shows they can still do profitable business, if they can just find some.
So, the company did a good job cutting costs and even improved its margin. But that's just the income statement. That's kind of like checking the patient's temperature. To really know how healthy they are, we need to look at the balance sheet. This is more like checking their vital signs, their blood pressure. It tells us about their core stability.
Now, before I show you the number, we need to quickly talk about working capital. The simplest way to think about it is this. It's what you have on hand to pay your bills in the near future. You take all your short-term assets, like cash, and you subtract all your short-term debts. A positive number is good. A negative number? Well, that's a big flashing red light.
And here it is. Incredible Holdings' working capital is negative $4.76 million. What that means is their short-term debts are almost $5 million more than their short-term assets. This is a really dangerous position to be in. It means they don't have the resources on hand to cover their immediate bills. It's a serious sign of financial distress.
And if you want to see just how tight things are, look at this. Their total cash in the bank at the end of all this was just $109,000. Think about that for a second. They have a nearly $5 million shortfall in working capital, but only a little over $100,000 in cash. This just hammers home how serious their situation is. They are operating on a financial knife's edge.
So what's our diagnosis? We've got a catastrophic revenue collapse, a really aggressive and smart response on the cost side, but a seriously strained balance sheet that threatens their very survival. The last step is the prognosis. What does the future look like? Well, the company gives us some clues, and it paints a picture of a really tough fight ahead.
Let's start with their distribution business, which used to be their biggest earner. The outlook here is rough. One of their major customers has scaled way back, which probably explains a huge chunk of that revenue drop we saw. Their plan? To go find new customers. But in a market they already called fiercely competitive, that's a huge challenge, especially when you're already struggling.
And what about luxury goods, the segment that went to zero? The headwinds here are even stronger. They're facing a perfect storm: tough competition, people not wanting to spend money on fancy things, and an unstable tourism market in Hong Kong. Their plan is to look for other places to sell. Basically, they have to build a new business from scratch in a tough market with almost no cash.
And finally, even their small loan financing business is getting squeezed. New online virtual banks are popping up, making things way more competitive. And we see the same pattern here. The plan is to, you guessed it, find new customers in a market that's only getting more crowded. For every part of their business, the challenges are huge, and the plan seems to be just hope.
And all of this brings us to one final big question. Incredible Holdings has shown that it can cut costs to the absolute bone to stay alive, but surviving isn't the same as recovering. The company is facing massive challenges in every single one of its businesses, and its plan seems to be more of a wish than a strategy. So can you save a company by cutting costs alone when the revenue engine has completely stalled? This report shows us that while you can cut your way to survival, you can't cut your way to growth, and that is the multi-million-dollar question hanging over their future.